Hi students, it is Carly here, and our topic today is cost of capital. This is chapter 2 in your textbook. So what is the cost of capital? You will see in the first chapter, we looked at the various types of long-term finance. If we take all of the types of long-term finance that a company has, and we add them together, or we calculate the weighted average of the cost of those various long-term sources of finance, we will get something called the weighted average cost of capital. Before we can calculate this though, we need to understand why is it necessary for an entity to calculate the cost of the various sources of long-term finance. One of the reasons is that they need to compare the various types of long-term finance to assess the cost and decide which one is best for them. A company is also going to invest in various capital projects to generate and maximize shareholder wealth. So in order to invest in these capital projects, the company needs to obtain the long-term finance and invest that finance in these long-term projects to maximize shareholder wealth. When we are going to compare which types of capital projects we want to invest in, i.e. which are going to maximize shareholder wealth the most, we need to assess the cost of these funds we are going to use to invest in these projects. If we know the cost of the funds we are investing, then we can clearly see which of these projects is going to actually maximize shareholder wealth and create value. When we are assessing these capital projects, we need to look at the future cash flows of these projects. And we do this in something called a net present value calculation. So in our net present value calculation, we are going to look at the cash flows of each of these projects. And then because these cash flows are going to happen in the future, we need to discount these cash flows with a discount rate. And the cost of the total funds, i.e. the cost of capital, is going to be the discount rate when discounting cash flows in a net present value calculation. Another reason why it is important for a company to determine the cost of its long-term funds is that the company will want to minimize the cost of these funds, and it can only do this if it is able to calculate the cost of these long-term funds. So what will have an impact on the cost of these long-term funds? One of the things that is going to impact the cost of finance will depend on the risk that the investor is exposed to. So an investor requires to be compensated with a return that is going to compensate them for the level of risk they are exposed to. So depending on the level of risk that an investor is going to be exposed to will help us determine the return required and the amount that the company will have to compensate the investors for. So the greater the risk the investor is exposed to, the higher the return they require. And one of the main things that will determine the level of risk that an investor is exposed to is the order in which they are paid on liquidation. So not everyone can be paid at the same time in the event of a company liquidating. There's an order that has to be complied with. So the first people to be paid first, or the first companies that are going to be paid first, are creditors. And here we split it into creditors with a fixed charge and creditors with a floating charge. So fixed charge creditors means that they have a charge over one or more specific assets of the company in the event the company cannot pay. Creditors with a floating charge will be paid second. So creditors with a floating charge is basically a creditor that has security on all of the company's assets in respect of their debt. The creditors that don't have security, i.e. unsecured creditors, will be paid third after creditors who have some kind of security are paid. After all of our creditors are paid, then we move on to our preference shareholders. So our preference shareholders will be paid next. After the preference shareholders have been paid, only then will our ordinary shareholders be paid. So as you can see in this order of payments, the ordinary shareholders are actually paid last, which means that ordinary shareholders are exposed to very high risk which means they will need to be compensated for that level of risk. So as we can see from this order of payment, in the event of liquidation, the cheapest form of finance is debt, because creditors are paid first at the top before preference shareholders and ordinary shareholders are paid. From this schedule, you can also see then that equity, specifically ordinary shares, are the most expensive form of finance that a company can obtain. Keep this order of payment in mind when we are considering how to calculate the various costs of capital and the risks that the investor is exposed to. The first type of long-term finance we are going to look at is the cost of equity. And how will we determine the cost of equity? The cost of equity is going to be the rate of return a shareholder expects for their investment. So a shareholder is going to buy shares in a company and is going to provide finance to the company. In compensation for the risk that the shareholder is exposed to, it will be compensated for this risk. So if we think about the things that will have an impact on the risk of a shareholder, one of the things we've just looked at is payments in the event of liquidation. As we saw from that order, ordinary shareholders are paid last, which means that it is the most risky type of investment that someone can have. Also, if we think about the returns that the company is going to pay to the shareholder, the company is going to pay dividends to the shareholder. So if we look at our formula here, we can see that the cost of equity is going to be calculated by comparing the dividend. This is the return that the shareholder will receive from the company. So the shareholder will be interested in the return that the company is going to pay them. So shareholders are going to buy a share and they are going to pay the market price of that share. So that money will go to the company and the company will use that money to invest in capital projects. So that is the price of the share. That is what the investor has given the company. The return that the shareholder is going to receive is going to be the dividend. So when we estimate the return expected by shareholders, we are going to compare the dividend that the shareholder expects in return for the price that they paid for the share. So you can see in the formula here, cost of equity is denoted by KE, and we are going to calculate this by taking our annual dividend per share, and we are going to divide that by the current share price, and this share price needs to be X dividend. So there are two types of share prices we can have, those that are X dividend and those that are cum dividend. If we go to the next slide, we can discuss these two types of shares. If a share is trading cum dividend, it means that it is trading with the dividend. So this is the price the share will be trading at when a company has declared a dividend but not paid the dividend. So if someone purchases the share and it is trading cum dividend, it means the investor or shareholder, if it buys the share, will have the right to receive the next dividend payment because it has been declared but not paid. So ex-dividend share price, this means without dividend. So if we have a share that is trading ex-dividend and someone buys that share, it means that they will not receive the next dividend payment. They do not have the right to receive that dividend payment. So it is very important in a question to assess the share price you are given. Is it a cum dividend share price or an ex-dividend share price? If you are going to be calculating the cost of equity, the formula specifically says we need to use the current ex-dividend share price. So we need to make sure we are using the correct share price, otherwise our cost of equity is going to be calculated incorrectly. If you are provided with both the cum dividend share price and the ex-dividend share price, and you want to calculate the cost of equity, you will use the ex-dividend share price. If you are not provided with the ex-dividend share price, but they give you the cum dividend share price and they give you the dividend, then you will deduct the dividend from the cum dividend share price to find out what the ex-dividend share price is, and you will use this as your P0 in your cost of equity formula. So this concludes ordinary shares. So now that we have looked at the dividend valuation model for ordinary shares. Now we need to determine how do we determine the cost of preference shares. So if we think about preference shares, the preference dividend is fixed at the commencement of the investor holding the preference share. So there is no growth or change in dividends that will be declared and paid to the preference shareholder. So the company knows exactly what the preference dividend paid to the preference shareholder will be. So we will determine the cost of our preference shares by comparing the return that the preference shareholder will receive for the price that they paid to hold the preference share. So here our formula to determine the cost of preference shares will be D, which is the annual dividend per share, over the current share price, which is P0. So if we use this formula, this will let the company determine the cost of preference shares. Just a reminder, there will be no growth in preference dividends because the dividend is fixed at the beginning. It does not change. When we looked previously at the dividend valuation model, that was the dividend valuation model where there was no growth expected in the dividend. Now, realistically, a company is going to grow, or a company is at least expected to grow. The shareholders require a dividend that is going to be linked to the performance of a company. So if a company is growing and it is performing well, shareholders will expect their dividend to grow in the future in line with the company growing. If we want to determine the cost of equity in a company that is growing or a company that is expected to grow in the future, we need to amend our formula slightly. So KE will equal the cost of equity. That is what we are trying to determine. Obviously, there's growth that is going to be expected. So D1 will be the dividend to be paid in 1 year's time. And the dividend to be paid in 1 year's time can actually be calculated if you have the current dividend today and you know what the growth rate is expected to be between today's date and 1 year's time. If we have our current dividend, D0, and we know what the growth rate in that dividend is expected to be, we can use that to determine our dividend to be paid in 1 year's time. P0 is the current ex-dividend share price. So remember I said if you are given the cum dividend share price, you need to subtract the dividend to determine what your ex-dividend share price is. In this formula, we also have G, which represents the growth. The G is going to be the constant rate of growth in dividends expected. So the growth rate is not always going to be given to you in a question. There are various ways we can calculate the growth rate, which we are going to look at on the next slide. But before we calculate the different ways we can calculate the growth rate, we need to first consider what the limitations of this dividend valuation model are. So if we look at the components making up this model, it is our cost of equity equals our D1, which is our dividend in 1 year time, divided by our current ex-dividend share price, which would be the market price, plus our growth rate percentage. So based on this, there are various limitations. This model assumes that dividends are paid. What if a company in the future is not going to be declaring and paying dividends? This would then not let you use the dividend valuation model because your D1 would be 0, which wouldn't give you an appropriate answer. It also assumes that the dividend growth is constant. In reality, dividend growth is not always going to be constant. Depending on the economy and what the industry is doing, there could be a recession, there could be a boom in the economy. This will all have an impact on how the company is performing and therefore on the growth in the dividends that the company is going to pay. So it is not realistic to say that the dividend growth can always be estimated and that it is going to be constant. So the dividend valuation model also assumes that the company has a share price. Obviously, publicly listed companies on the JSE will all have a share price, but companies that are not listed, like private companies, will therefore not have a market share price available. So it is very difficult to estimate this if it is not publicly available on a share or a stock exchange. So when we looked at the model, we said that because our dividends are expected to grow in the future, we now take into account the growth in dividends. And like I said, the growth rate will not always be given to you in a question. Sometimes you'll actually need to calculate the growth rate. And at this level, there are two ways that they expect you to calculate the growth rate. You can either calculate the growth rate by looking at historic growth in past dividends, or you can look at the current reinvestment level. So when we're looking at the historic growth in dividends, so you can calculate the historic growth in dividends by comparing the most recent dividend to a dividend paid in the past. This will allow you to identify the annual growth rate in dividends. Then based on this growth rate you have calculated, which occurred in the past, it could be assumed that this will continue in the future. So if you calculate that the growth in dividends in the past was 5%, you can then assume that going forward your growth rate will be 5%, and you can use this in your formula. To calculate your latest dividend, you obviously need to know the dividends in the past so you can calculate the growth rate in those dividends. So if you rearrange this formula here, you can calculate the growth rate by comparing your latest dividend to your past dividend. So if we want to calculate the growth rate using the current reinvestment levels, here we are basically assuming that any increase in what is invested in the company, i.e. not paid out in dividends, this will result in the company to grow and flourish. And if the company is growing, it means that what they pay out later, i.e. future dividends, so the current reinvestment level assumes that any increase in what is reinvested in the company instead of being paid out will result in an increase or growth in the company, which will therefore result in an increase in the future dividends that the company will pay to its shareholders. So how we calculate this method is that we need to know what our return on net assets is, and then we need to know what portion of this return is going to be reinvested in the company instead of being paid out as a dividend. So if we know this, we can calculate our annual growth rate in dividends. Next type of finance we are going to look at is a bank loan. So now that we've looked at ordinary equity, let's have a look at debt. So it is likely the company will have to obtain long-term debt as well to finance some capital projects. So if we think about bank loans, this is usually the simplest type of debt. So the investor or lender is usually a bank, and the return required by a bank to compensate it for the risk it is exposed to is the interest that the bank will charge on the loan. So before a company takes out a loan, it will obtain the terms of the loan agreement, and it will have to sign this agreement. And in that contract or agreement will be the interest payments that the company will have to make on that loan. So the return required by the bank is the interest that it will charge on that loan. Obviously, the company will also have to repay capital amounts. Then if we look at the company perspective, so this is the company that is borrowing from the bank. The cost of debt to the company is the return required by the investor or bank. So the cost of debt to the company is the return required by the bank. Therefore, the cost of debt is actually based on the annual interest that the company has to pay to the bank on the loan it has taken. However, there's something else we have to take into account. When a company pays interest, it actually gets a deduction which will reduce the taxable profit, and therefore it will also reduce the tax charge. So the cost of debt to the company is the annual interest charge that it needs to pay to the bank, but this needs to be net of tax because the company will receive a tax shield. The company will receive a tax shield on that interest payment. So we need to look at the net of the two. We will consider what is the annual interest cost. Then we will consider what is the tax shield the company will be given on paying that interest. And the net of those will allow us to determine the cost of debt. So as you can see, we have a formula here. KD is the cost of debt and I is the annual interest rate that the bank will charge. Then from that interest rate, because the company will receive a tax shield when it pays the interest, we need to take out the tax shield that the company will get when it pays the interest to the bank. So here we would need to know what the tax rate is, and this will be given in the question. So if you have the annual interest rate and you have the tax rate, it is quite easy for us to determine the cost of debt from a bank loan. Like I said, it is the simplest type of debt. There are more complicated types of debt that we'll look at. We also have bonds, and bonds can be irredeemable and they can be redeemable. So irredeemable bonds. So it is very unusual for bonds to be irredeemable. If a bond is irredeemable, it basically means that the company does not have to repay the principal to the bondholder. So it is irredeemable, it will never be redeemed. So the annual interest returned to the investor will be the fixed interest only. So bonds are traded in markets. We looked at bonds in the first chapter and we looked at the various markets that the bonds can trade on. So if we have an irredeemable bond, the investor will calculate the interest yield or the yield to maturity. So what is the yield to maturity? This is the percentage return by comparing the interest received to the market value of the bond. So the yield to maturity can be calculated by taking the percentage return or the annual interest on the bond and dividing it by the X interest market price of the bond. You can have a look at that formula in your textbook. If we look at an irredeemable bond from the company perspective, so if we want to determine the cost of debt on an irredeemable bond, remember when we looked at equity, we said the return to the investor was the dividend. And in a similar way here, the return to the bondholder will be the interest paid on the irredeemable bond. But we also need to take into account the fact that when the company pays this interest, it is going to receive a tax deduction for that interest, which is known as a tax shield. What is the net effect? We want to know what is the interest net of the tax relief to determine the cost of debt. So we can determine the cost of debt by comparing the interest net of tax that will be paid to the bondholder and comparing that to the market value of the bond. So in this formula, you can see that KD is our cost of debt, I is our annual interest rate, T is our corporate tax rate, and P0 is the X interest market price. So if we know all of these variables, we can determine the cost of debt. So just remember, when you are looking at the cost of debt, we want to know what the interest is net of tax. And the reason for this is that when the company pays interest to the bondholder, it will receive a tax deduction for that interest, which will reduce its taxable profits, and it will also reduce the tax paid to SARS. Now that we have looked at irredeemable bonds, we can look at redeemable bonds. Redeemable bonds are often more complex than irredeemable bonds or equity. So remember, we said irredeemable bonds mean that they will never be redeemed, the capital will never be repaid, whereas redeemable bonds are different. Here, at some future date, the capital amount is going to be repaid. So from the investor's perspective, the return on redeemable bonds will be based on the interest earned plus the difference between the amount paid for the bond, i.e. its initial market value, and the redemption value of the bond, i.e. what is paid back to the investor on redemption. So often, the redemption amount could be at a discount or a premium. So it doesn't necessarily mean that the bondholder will get back the same amount that they paid. Often the redemption amount will be at a premium to compensate the bondholder. So the return to the bondholder or investor is referred to as the yield to maturity. So what we have to do here is we need to analyze the cash flows that the investor will receive. So if an investor invests money in a bond and receives returns in the future in the way of interest and redemption amount, we need to analyze those cash flows to determine the percentage return that the investor will receive. This is called the internal rate of return of the bond, which is also known as the yield to maturity. So this sounds confusing, but the first thing you have to understand is what is the internal rate of return. So when we calculate the internal rate of return, it is an annual percentage return achieved by a project at which the sum of the discounted cash flows over the life of the project is equal to the sum of the discounted outflows. So you can calculate your internal rate of return for a capital investment project. So the internal rate of return of the bond is similar. It is also referred to as the yield to maturity, and it is the internal rate of return of the market value of the bond. So it is the annual interest received and the final redemption amount. So when we want to calculate the yield to maturity, we are basically wanting to calculate the internal rate of return of the market value of the bond. And you'll see in your textbook that there's actually a formula to calculate the internal rate of return. And you can calculate it as the textbook does with the formula. But I would also strongly encourage you to know how to calculate the internal rate of return on your financial calculator, as this will save you time in a test or exam. So if you want to use the formula to calculate the internal rate of return, there are various steps laid out in your textbook. So step 1, you would have to estimate a rate. In this example, they use 5%. So here you would have to know your cash flows, and then you would calculate the net present value of the cash flows at any rate. So they use 5% as an example in the textbook. Then step 2, you would calculate the net present value of the cash flows at any other higher rate. The textbook uses 10%. So step 3, you would estimate the internal rate of return. So once you have done step 1 and step 2, you will then use the formula and you will insert what you have calculated, and this will help you determine what the internal rate of return is. So if you look at the formula there, L equals the lower discount rate used, and this is the discount rate that we calculated in step 1. H is the higher discount rate. H is the higher discount rate which was used in step 2. Then if we look at the net present value of L, this is the net present value using the lower discount rate, which we calculated in step 1. And then we also need to know what the net present value was using the higher discount rate, which we used in step 2. Once we have calculated this, using our estimates, which in this question was the 5% and the 10%, then you can actually insert that into the formula to calculate your internal rate of return. But I would also strongly encourage you to know how to calculate it on a financial calculator. And then even if you use the formula, you can just check it on your financial calculator to make sure you haven't made a mistake. So if we look at the cost of redeemable bonds from the company perspective, we'll see that the cost to company needs to take into account the tax relief, just like we did for the irredeemable bonds. So remember, the company is going to pay interest payments to the bondholder. But when it pays these interest payments and reflects it in its tax calculation, SARS is going to allow a deduction for these interest payments at the tax rate. So we need to take into account what the tax shield is going to be on these interest payments. So the relevant cash flows from a company's perspective. So the company is going to issue bonds and the bondholder will buy these bonds. So the company is going to receive the market value of the bonds at year 0. And then from year 1 to the redemption date of the bond, because these are redeemable bonds, the company will be expected to pay interest payments to the bondholder. But remember, this will be net of tax because the company is going to receive an interest tax shield on these payments. On the redemption date, the company is going to pay the redemption amount to the bondholder. So far we have looked at the cost of debt for redeemable bonds and irredeemable bonds, but we also need to take into account convertible bonds. So what are convertible bonds? So convertible bonds will offer the bondholder a choice of cash or shares on the redemption date. So the bondholder will buy these convertible bonds, and on redemption date, they will either decide whether they want to take the cash or they want to convert these bonds into ordinary shares. So we assume that the investor will take the higher of the value of cash or the value of the ordinary shares. Some investors may choose cash if they need liquidity, while other investors may decide to convert their convertible bonds into ordinary shares, as they have the hope of receiving future dividends and they are hoping that those future dividends will grow. So when we calculate the cost of debt for convertible bonds, we can assume that all investors will make the same decision. That is, they will choose the option that provides them with the highest value on redemption. So if cash is higher than the value of the ordinary shares, they will take the cash. But if the value of the ordinary shares is higher than the cash, then the investors will convert their bonds into ordinary shares. So when we calculate the cost of debt, we'll need to decide which of the two has the highest value. Does the cash have the higher value, or does the shares on redemption date have a higher value? Based on that, we know the investor will choose the option that provides them with the highest value on redemption. Cash flows from both options will need to be compared to determine which option has a higher value. So once we have determined which of the options the bondholder will take, we can determine our cash flows. So at year 0, the company is going to receive the market value of the bond. The bondholder will take up the bond and will pay the company the market value of the bond. And these bondholders will hold the bond, and they will receive annual interest payments net of tax until redemption date. At redemption date, we need to take into account which is higher, the cash value on redemption or the estimated future value of the shares. So now that we have looked at the various sources of long-term debt, we have looked at ordinary shares and we have looked at how to calculate the cost of equity of those shares. Remember, we looked at a dividend valuation model where there was no growth, and then we also looked at the dividend valuation model where we expected growth in dividends. So just make sure you know how to calculate the cost of equity under both of those circumstances. We also looked at preference shares and how to calculate the cost of these preference shares. Then we looked at the various types of debt. We looked at bank loans, which we said were the simplest form of debt, and then we looked at bonds. When we looked at bonds, we had redeemable bonds, irredeemable bonds, and convertible bonds. All of those types of long-term funds have a different cost associated with it. And remember, we said this cost is basically the return that the investor expects. And this return needs to go to the investor to compensate them for the level of risk. So once we have all of our costs of our long-term funds, we actually want to determine something called the weighted average cost of capital. We want to know what is the average cost of all of our long-term funds. And the reason we want to know a weighted average is that often a company is going to invest in various new projects. We want to calculate a weighted average cost of capital. And to calculate a weighted average cost of capital, we need to know the cost of capital of each type of long-term funds obtained. And one of the reasons we want to calculate a weighted average cost of capital is that entities are continuously raising long-term funds from various sources. The company is always obtaining new funds to invest in capital projects. When these long-term funds are obtained, they will be used in both existing operations or they could be used to finance new projects. So we basically have a pool of long-term funds that will be used in various projects. Often, the company will obtain a long-term fund and they could use a portion of it for a new project and they could use the other portion for an existing operation. So we actually need to calculate a weighted average cost of capital because the pool of funds is used to finance various projects. And to evaluate these projects using the net present value method, we need to determine what the cost of these pool of funds is. And this is called the weighted average cost of capital. And we will use this weighted average cost of capital when we are assessing new projects that the company is going to be invested in. So the weighted average cost of capital, it's basically a measure of the overall cost of the company's finance. It is the average cost of capital, the average cost of all of the long-term finance. Obviously, it is going to be weighted according to the size of the long-term funds. If you think about the pool of funds, it can consist of ordinary shares. The company can issue preference shares to obtain long-term funds. They could also go to the bank for a loan, or they could issue bonds. All of these funds are going to be going into the company's bank account. And then from that bank account, a portion of the funds could be used in new projects. Some funds could also be used for existing projects. So we want to know what is the weighted average cost of capital of all of these funds in the pool. And we can actually calculate the weighted average cost of capital by using our formula. So we want to know what are the various types of finance that the company has. They could have equity, they could have debt. In our formula, we will need to know what is the cost of equity. And this is shown by KEG. This is the cost of equity in a geared company. So a geared company, this is a company that has both equity and debt. So if we have our cost of equity, we will also need to determine our cost of debt. And remember, we looked at how to calculate that previously. And we said that our cost of debt is going to be after tax because the company is going to receive a tax shield on that interest from SARS. So when we're looking at our cost of debt, you can see that in the formula we have provided for the tax shield by going 1 minus t in the brackets. We will also need to know what the total market value of our ordinary shares are, and we will need to weight this. The total market value of our ordinary shares is shown by VE in the formula. Then we have VD, which is the total market value of debt. So once we have our market values and we have our cost of equity and cost of debt, we can calculate our WACC. If we are attempting to calculate the weighted average cost of capital, there are various steps that can be taken to help you when attempting this question. So the first step is to identify which types of long-term funds are given in the question. They could tell you that the company has issued ordinary shares, and in that case you would know that you need the cost of equity. They could tell you in the question that the company has issued bonds, and therefore you would need to know what the cost of debt is. So once you have identified which types of long-term funds are given, is it debt, is it equity, you can identify whether the cost of each type of long-term fund has been provided. Have they given you the cost of equity? Have they given you the cost of debt for the bonds? If they have given it to you, then you will use that in your formula when you are calculating your weighted average cost of capital. If the cost of long-term funds is not provided, you can calculate it using the formula that we covered at the beginning of the lecture. Once you have calculated the cost of equity and the cost of debt and the cost of the various sources of long-term finance, you can calculate the market value of each type of long-term funds. Once you have the costs and the market values, you can enter these into the WACC formula, and this will give you your weighted average cost of capital. So just to recap, what are we going to use the WACC for? So WACC is often used as a discount rate in project appraisals. So a company will need to invest in capital projects to generate shareholder wealth or shareholder value. So to assess these capital projects, they need to know what the cost of the capital is that they are using to fund these projects. And remember, we said because the funds are pooled, we need to determine what the weighted average cost of capital is. So when we perform a net present value calculation, we will need to use the WACC as the discount rate to discount the cash flows, depending on when they occur in the future. If the project has a positive net present value, when we have discounted using our WACC, this means the project will generate shareholder value and the project should be accepted. If we have discounted our cash flows using our WACC and the project has a negative NPV, it means that the project should be rejected because it doesn't generate a return to shareholders. It will destroy shareholder value. So we have said that we need to use the WACC as the discount rate when we are assessing net present value calculations. But one thing we need to take into account is that there are following conditions that need to be met for us to use the WACC. So if we are assessing a new capital project and there is no change to the financial risk as a result of accepting that capital project, then we can use the weighted average cost of capital we have calculated. If we are taking on a new project and there is no change in the business risk, it means we can use the weighted average cost of capital calculated. If that capital project will result in a change in the business risk, perhaps it is in a new industry that the company is not familiar with, if it did change the business risk, then we would have to adjust our weighted average cost of capital to take into account the fact that this capital project is more risky. So just make sure if you are doing a net present value calculation that the capital project is not going to result in a change in the business risk. If it does not, you can use the weighted average cost of capital calculated. If the capital project results in a new investment that is marginal to the company, then it is also appropriate to use the weighted average cost of capital here. One of the other things we need to determine, the formula for WACC shows that we use the market values for the shares and debts. But what happens if the market value cannot be determined easily? What happens if the shares or debts are unquoted? If you are in a situation where there is no market value for the shares or debts, you can either estimate the market values by the information provided in the question, or you could use the carrying amount and you will assume that the book value given to you will equal the market value. But if you do this, if you use the book value instead of the market value, or you estimate the market values, this will result in your WACC figure calculated not being accurate. So just keep this in mind if you have to use one of these alternatives. Okay guys, that should bring us to the end of the lecture. Thank you very much for listening, and I hope you learned something. Please make sure you have a look at your textbook and you go through the examples in your textbook. Thank you.